Happy Friday, everybody. Welcome to the Talk with Kiet show, where we connect people, ideas, and capital to help make a difference. Today, I am on with Nelson Chu, the founder and CEO of Percent. Nelson and I will talk about his extensive entrepreneurial journey and his career in capital markets, as well as how to democratize private credit. Now, before I start, I also want to congratulate Nelson for being on the Crain's New York 40 under 40 list. Nelson, welcome to the show.
Thanks so much for having me. And we've gotten to know each other really well these last few weeks, and I'm glad this happened.
I know. I'm excited. Look, I think the Womankind event was great to connect us. I also think it's a great cause. So anywhere, any option I can plug Womankind event, I will. Anyone that wants to explore and learn more, please Google it and get involved. So Nelson, on the show, where we usually start is the origin story of the entrepreneur, because I always think that's a really interesting story. We always talk about the glamour, but we don't understand like the hard work, the grit, the uncertainties we all had to go through to get to where we are. So what is the origin story of Nelson?
Yeah, absolutely. You're going to have to rewind all the way back to suburban New Jersey in like 1990s. So I grew up, regular middle class upbringing, I would say. I had a more conventional, traditional Asian mom who had certain expectations around schooling and academics and STEM and, becoming a doctor, lawyer, or banker. And then I had a father who was an entrepreneur in his own right. And so he had co-founded a software company with a bunch of his friends. Naturally, I think when you're an entrepreneur yourself, you start to just see the world a little bit differently, see the world as like opportunity and wanting and being willing to try things. And so when I was younger and growing up, I think I had the fortune of being able to try a little bit of anything and everything that I was personally passionate about. And his rule of thumb to me was like, look, if it's under $1,000, you're not going to throw it away in 2 weeks, then like I'll get it for you, and just please like stick with it for a little bit and don't drop your academics, right? And so I didn't drop my academics that badly, but it wasn't that great. I was like not a very good student, but I did try a lot of things, right? So I bought myself a Mac in like 1999 before anybody really bought Macs back then. I taught myself Photoshop, taught myself movie making, modified the heck out of my car, all things that I actually was interested in. And that spurred a lot of creativity, right? But after graduating high school, you kind of got to go to college. So I had to do that. Went to Rutgers, literally not too far from you, actually, from where you are. And in 3 years, I realized I do not like academics at all. I definitely don't like academics, if that's the case. So I tried to graduate in 3 years, did a double major, econ, poli-sci, minor in philosophy, none of which is all that useful today, maybe philosophy, which I actually enjoyed. And I graduated in the very, very wonderful year of 2009, which, rewinding back, was like the deep of the global financial crisis, where you weren't sure if your analyst offers are going to get honored and all that stuff. So yeah, had to get a job. Would love to be a lawyer before I realized I didn't want to go any more years of academia. So worked at Merrill Lynch. I was the last summer analyst class for Merrill Lynch before it became Bank of America. And so I did about a year and a half at Bank of America, a year at BlackRock, before there's a trend here. I realized I was a terrible employee, and I didn't want to do that either. So after about 2.5 years of traditional finance, of which I don't think I learned that much about finance in that time frame, I decided to do my own thing. And the New York tech ecosystem was really taking off in like 2012, 2013. And I thought there was a great opportunity to kind of try that, because how hard could it be to start a startup? And I realized very quickly, and I'm sure you can appreciate this too, starting a startup is very hard. And so within the first 6 months of quitting my job, I had tried and failed to start my startup in social news, which was very sexy at the time. And I realized, okay, I'm broke. And I think when you're broke, you set up a single person LLC and become a consultant. So I ended up becoming a consultant and built a company out of that, helping other founders build their companies from the ground up, not making all the mistakes I made in the first 6 months. And whether I liked it or not, because I didn't like finance, I kept getting fintech companies, because literally they saw my finance background. And they were like, awesome, you know how to do a P&L, you understand finance, let's work together. And after 5 or 6 years of doing that, realized services was not the most fun thing to be selling all the time. And that's how Percent came to be. So I'd like to think that everything I've done up to this point has led me to where I am today. No regrets. As much as I don't like academia, as much as I don't like corporate, as much as I don't like finance, traditional finance, it's still important for my growth, my development, and I wouldn't be where I am without the experiences that I've had.
No, that's actually a really good point, because a lot of people we touched on the topic of gratitude, right? We always think gratitude is all the good stuff that happened to us, but actually the bad stuff is help make us who we are today as well, right? That experience, that learning journey we have.
Yeah, I love failure, actually. I think you learn the most out of failure. I think if it's only good times, you actually don't even understand or know what to do in bad times. And there will always be bad times. I think life is like a series of uncorrelated crises. That's just kind of like what it is. So, and I think a company is the same thing, right? Organized chaos is kind of the way to think about it. So if that's the case, like it takes a lot of grit, it takes a lot of resilience, it takes going up against adversity head on and just figuring out what to do, and don't get emotional, don't get too riled up, and just think very objectively and rationally about how to solve this. And I think failure teaches you a lot of those things. So I failed all throughout my life, but I think I've gotten better because of it.
Yeah, look, if you never quit, you technically never fail, right? So
that's a very nice way of putting it. I've definitely failed before, for sure. But yeah.
Well, actually, talk a bit about, because you mentioned about your mom on academia and your dad being an entrepreneur, right? Like the Asian upbringing, right? An A is an average, a B is below average, right? That mentality, right?
I was so below average. Oh my gosh, yes, yeah.
But that's the upbringing, right? It's like
Mm-hmm.
we tend to come up with a mentality of being trained to be the perfect worker, the perfect employee, right?
Yeah, no, for sure. And it's part of our culture, right? I think in so many different ways. As I guess I'm second generation, right? So as a first generation, I think you're always taught like if I do good work, good things will happen, and like it's very meritocratic. And the reality is, I think corporate and just business in general is not always like that, right? You got to learn how to sell yourself. That skill is one of the most important skills you can build. And so I think I learned early on that this was going to be something that I had to get good at. And I was very lucky that I was able to work at Apple, actually, believe it or not, in a random Apple store in suburban New Jersey, to be able to actually learn a lot of the sales skills, which back then they still taught you a lot of that. Now this stuff sells themselves. In 2007, like college kids were not really buying Macs. It was like a little weird to be buying a Mac. So, I think same thing. Had to sell a college kid on a laptop that none of their friends were using. And you had to throw in a printer and a key and a lock for, to make sure it doesn't get stolen, like all the like the packages you can throw at that, right? So to be able to convince them was usually like an hour and a half affair, like to be able to just talk them through it, show them, make them see why this is so much better. So it taught me a lot. It taught me a lot about like how to sell myself and recognize that like just doing good work is not going to be enough. And it's been, I think I've kept those skills ever since.
No, exactly, and I do think, because I go through this debate a lot as well. Like I'm an entrepreneur. My wife's really smart, amazing, very strong academically. So we always have this debate on how to raise our kids, right? Do we raise them more academic? Do we raise them more entrepreneur? Like in a way, I'm like mix of what your dad did for you in a way, like to my kids. Like you just got to try new stuff. Like you still got time. You got to figure it out. No one's got the answer right now.
Yeah. Look, I think teach the kids good values, make sure they're good people intrinsically, right? They have good character. And then the rest of it, like they will figure it out when you give them the opportunity to do that. For sure, academics isn't everything, but I could be the first to admit that like if you got into like an Ivy, like a Harvard or a Stanford or whatever, you're going to start up with a leg up, and like every parent wants their kid to have a leg up, right? So like academics does actually make a difference, just to have an advantage in some way. But yeah, the truth is like, pursue what you're passionate about. Think something that you'll think about all the time that you really want to solve for. And that will drive you through some very difficult times as well.
Yeah. So actually, so that's a good transition, because you go through the entrepreneur journey and then you came up with the percent startup idea. Like, how do you know like percent was it? Like, what were some of the signals or driver for you to say, okay, this is the opportunity. This is what I need to focus on.
Yeah, the consulting company actually taught me a lot. And I look back on that time really fondly, even though I was like struggling to make payroll every like few weeks, because running a services business, you're kind of just calling invoices, you get paid all the time, and trying to figure out how to, actually make that stuff line up, AP and AR. So back in 2017, we had a lot of insight into the fintech landscape because a lot of our clients were fintech companies, right? So we knew what was working, what wasn't working, what gaps there were in the market. And what we saw was actually at that point in time, alternative investments was kind of well understood. Like a lot of companies had done the legwork to educate users and investors about what alts were. And that ranged from equity in companies to real estate to, I think, collectibles was like starting to get really hot too as well, right? And that's when we were thinking, okay, so there is a well-educated population here around what this is. So we don't need to do that. But the value prop for this user base is actually not that great, right? There was super long duration investments. We were like talking 4 to 5 year lockups, which the reality is, as a random person who's looking at a company to invest in, I'm like, are you going to be around in 4 to 5 years if I give you this money? That's a big question, right?
Yeah,
and it required a big upfront lift. It was like 25, 30 grand as a minimum. And if it was a yielding product, then the yield was the same everywhere. It was like 9 to 16%. So we knew if we came up with a product that was shorter duration, like 1 month, lower minimum, like $500, and the yield is the same, 9 to 16%, I'd probably get some users out of this because we just intrinsically have a better product and there's no brand loyalty to your alternative investment platform, right? So we knew that's one way to start a company, which is the legwork's already been done. You just offer a better value prop. And now it's how do I acquire customers that already exist somewhere else? This wasn't a game-changing idea where we had to educate a population on like how to use an iPhone, right? That's like completely brand new. So that was good. But I also knew going into it that with pretty much most startups, where you start and what that idea was on the napkin is not going to be where you end up. There's going to be so many twists and turns along this journey that the truth is, you know what? As long as you're not married to that idea, start with something, get it off the ground, get a little bit of product market fit, and then it'll figure itself out from there.
So talk about going through that journey and raising capital, because it must be tough in the early days from that perspective.
Oh, it sucked. Like, trust me, looking back, like I, who had advised a bunch of founders, had never actually raised $1 myself before, technically, right? So it was a very, very different journey to do it myself and actually go on that fundraising cycle. Looking back, I also had not the slightest clue what I was pitching. So, if I was looking back at my first pre-seed deck, in my head, looking at it right now, I'd be like, I don't think I'd invest in this company. Like, I don't know what this is. And that's part of it, right? Like you get better over time. The idea becomes more refined over time. You have more to show over time. So in the beginning, which is, I think, good for most pre-seed investors, they're actually investing in the founder and the team more than anything else, right? Ideas can change, as we've just talked about. And so if you do believe you have a team that can execute, then that's why you should be investing, because good teams will figure it out along the way. And I'd like to think that we've proven that out. But the first idea that we pitched was like some security token blockchain, like whatever, back in 2017, 2018, which was, a lot more attractive back then, and a lot more interesting, kind of dead in the water now. But we got some people interested, and it was just almost like brute force. Like it's a numbers game at the end of the day. I probably pitched like 80 or 90 investors for that pre-seed round for, $2 million. That's what it took, right? A lot of them were angels, which is fine. But that's essentially what is required when you don't really have that much clarity around what you're actually doing and what you're building until later on in the process. And it did get easier. Seed round was a little bit easier, Series A a little bit easier, and then Series B was an absolute nightmare given the timing of when we raised.
Yeah, so before we go into that, because I love touching on that, but before we go into that, you highlight a good point. That is, a lot of people think like they have everything figured out by the time they start their startup. They have everything figured out by the time they fundraise. And it's actually an excuse to procrastinate, right? Because with entrepreneurs, it's about just starting. Just get going, just starting. And the reality is no one knows everything, right? You're going to learn as you go along.
Yes. If you think you know everything, you're going to be completely blindsided by what actually you need to be doing. Because you won't be listening to your customers. You won't be evolving the product in a way that meets the actual needs and solves the actual problem. You'll be so wedded to the one thing that you won't be able to see the forest from the trees. And that's dangerous, right? I think, honestly, like in many ways, building a startup at the earliest stages is the most fun because you have a team that's small, that's like fully, I think, like aligned. Like there's no, there's no one-on-ones. There's like none of these things that are like operationally have to happen later on. You're just like, we're talking all the time. Everyone knows what they need to do. We just got to go and we'll figure it out. And at that point too, more importantly, like the world is your oyster, right? So like you literally can do anything and everything you want just based upon how you see the market reacting to what you just did. And you can drop something immediately and do something else, right? Like that, because it just seems like a better option at the time. That's an exciting time, right? And that's a very, very different time. So I always find that to be the most interesting, most fun, most exciting. And then you start to have to put structure around things because your team gets so large, and you start to, look and more feel like a larger company, which comes with larger company problems, but also good things as well, because you're not going to be running out of cash like tomorrow, which is also a good thing.
Yeah, exactly. Though, so in essence, you're saying, look, a startup to start is just a hypothesis, and you got to figure out how to get the right signals to test that hypothesis and evolve, right? I guess the question for you is, do you have a structure? Like, what are the trick of the trade to really try to pinpoint those signals?
Yeah. What's interesting is actually a startup at the earliest stages, no matter what sector you're in, is kind of always the same. Like the playbook is the same, right? Anything up to $1 million in revenue, the playbook is literally exactly the same. So you need to create, first of all, you need to, if you're raising money, incorporate properly, do a C Corp, don't do an LLC, right? Make sure you test your trademark, make sure it's not, violating anything else, get a website going, put up a splash page, start running ads against that splash page, tweak the message, see what converts, get signups into the door of what you're looking for, and then start to create some sort of lifecycle marketing when you actually have the product, run a beta, like do all that from there, and then the revenue will start coming in, right? And now at that point, it's okay, does this product meet exactly what they're looking for? How much can we push in terms of feedback that we're getting? Make sure you motivate your biggest advocates early on through whatever it is method you want to do it with. And then it just keeps growing and momentum starts building, and you'll probably get to $1 million in revenue. Like that's just like pretty conventionally tried and true. From there, it's all about sector specific domain expertise, right? You start to need to really finesse the product in a way that is in line with what customers are expecting. But the signals at the outset, at the beginning, are pretty clear. It's like, what's my conversion rate? Is it going in the right direction based on the messaging that you did? Is usage going up based on the features that you launched? Like those are all very telling. And make sure that you're constantly listening to customers at that point in time. That is the most critical. And believe me, like I think when people are, it's funny because like when you're early, customers know that you are early, and the ones who are kind of super engaged actually just like being early. Like they like being known as like, I found you first, right? And they'll be super helpful if that's the case. Want to be a part of a focus group, like getting to test features early before anyone else can see it. It makes them feel good. So literally make them feel good, send them swag, do all the things like, meet up with them in person. We did a lot of that. Like when we first started, we had, I think like a couple thousand people on our sign up list just from running paid ads and things like that. And then when we launched with our first deals, we sent an email out to all these guys to say, hey, like it's ready to go. And yeah, like probably 1% converted off of that 10,000. But that crew, a lot of them have stayed ever since. And obviously, because we're an investment platform, we know where they are. So if we're traveling to SF, if we're traveling to Miami, we would just hit them up and be like, hey, like would be great to meet. I know that we've only spoken over our customer support chat, but would love to kind of hear your thoughts, get your feedback, things like that. And they love that. Like they really love being a part of that process. And they do make your product better because they actually care. I think as you get larger and larger, people start using you sometimes out of necessity because their company demanded that you use them. Otherwise, like, the beginning audience is the most happy with you and wanting to help.
Yeah, so it's really about finding your fan base, right? Whether it's 10, 50, 100, and just leverage that as a starting point.
You don't need a lot. Like they have their own networks. They love to blast it out. There's like a few people that are users of the platform that like every single one of my LinkedIn posts within 5 minutes of me posting. And I'm just like, you must have some alert on for me, but like, yes, I appreciate it. And, we try and give back where we can to that very, very passionate fan base.
Yeah, no, exactly. And then, okay, now let's touch on the fundraising, the fun stuff, right? Going through the A and the B. Like, what's that experience been in the last few years?
The A was fine. 2021. Oh my goodness, that was easy. Yeah, I think fundraising in 21 was actually really not that complicated. It was by far the easiest round that we were able to do up until that point. I think the only thing that I would say is, in 2021 and 2021, multiples were insane, if you remember. So like we're talking like 100x, like forward-year revenues on projections that nobody battle tested, right? Which is just absolutely crazy. And I think my advice to founders is always like, use your brain. I think like use your best judgment, honestly. Does that seem right? Like, do you actually think you can justify 100x multiple on your next year's revenues with what you have today in your business plan? And do you think that just because that seems to be the case that everyone else is doing, that'll stay in the next year when you come back out to market to fundraise? Like, logically, does that really seem possible? And I think we're all going to say no, that's not. And so don't raise that evaluation at 100x multiple, because you'll never live up to it if that's the case. And if you don't, then literally not just you, but all of your employees are done too. You're wiped. Like, you're going to have to recap the company or go under, one or the other, right? And that's not a situation you want to be in. So be pragmatic, be thoughtful. And for us, we raised that evaluation that was, I think it was like a 2x step up, maybe a little bit more. No, it was a 3x step up on our Series Seed, which is fine. It wasn't a crazy valuation. I think we were trading at probably 20x current year revenue, maybe, give or take, something like that. So not forward year, current year. And that's reasonable, right? Like, I knew I could live up to that valuation no matter what happens the next go around. So fast forward to the Series B. We tried to raise in March of 22, which, if we go back in time, literally Russia invaded Ukraine the week after we went out to market, essentially, which meant that, if you remember that time, all VCs were pencils down. Like, they were like, we need to see how this market goes. Like, we're not going to be doing anything. Every excuse under the sun came out for why they weren't investing. And every week, like, it seems like all the VCs colluded. Like, this week is about not enough revenue. That week is about your expenses are too high. The week after that, it's like your net income's not right. Like, whatever it is. But we had to put a pause, right? And so in that time frame, I was still a little bit bought into the hype. I was like, in 2021, oh, I'll be able to raise in a year. That's fine. Let me run through our burn so that I have about 18 months of runway, right? So going into March, I was like, okay, I'm going to start this process with a few months of runway left. This will be easy. It was not. So we had to raise venture debt for ourselves. And we had the fortune of running a platform that allowed us to do that. And also, we wanted to test really whether our audience would like corporate debt, not just, securitized debt, right? And the answer was resounding yes. And again, going back to the fan base, I so appreciate that we have an audience that loves what we offer, that they're willing to back us, not just in investing in our deals, but even investing in debt for ourselves as well, right? So we were 1.5x oversubscribed on our venture debt, which meant that there was definitely appetite there. And that's how we launched our venture debt asset class. But yeah, that got us through pretty much 2022, right? And in that time frame, in 2022, nobody was really cutting checks. So the only thing I could lean on was investors that I'd had known for years, who I pitched 2-3 years ago, saying, we're going to get here, right? I promise. Might take a little bit of time, but we will get here. And it took talking to those groups again, who have already seen us, followed us, believed in us, to say, okay, you've done enough. No one else is cutting checks, but this is a good entry point because your valuation is not that crazy. And so at that point, we were able to get a first close in. That was probably like 300 conversations, give or take, in to get the first close into the door. And then this was November of 22. Silence after that, right? Like, I was not even fully closed the round. I had a very aggressive term sheet in the sense that I had to clear a certain threshold for it to make sense. And at November, December, no one's really writing checks. They want to see what full year 22 looks like, right? Every VC's waiting. And it literally took SVB going under in February and March. I forgot what I think it was March or February. No, I don't know. Yeah, well, something like that. For every VC to come back and say, oh, this is what private credit is. Oh, this is what you do. And like, oh, I didn't realize you could bail out my companies when they're in distress. And I'm just like, I've pitched the same thing like 5 years now at this point. You just didn't really quite understand what we did, but I'll take your money now, thankfully. And because of SVB, we were then like extremely oversubscribed on the Series B. We were looking for a $20 million round. We ended up raising 30. So that was very, I think, telling for, I think, when you need to be able to get lucky in the time of making a startup. And you need to be able to also capitalize on momentum swings when they come your way and be willing to kind of see it to be able to take advantage of it. So yes, this was a Series B process, started in March of 22 and ended in May of 23 with about 475 conversations with 125 VCs to be able to get that over the finish line. By far the hardest fundraise we've ever done. I hope I never have to go through that again. I don't think I will, knock on wood, but it taught you a lot about sort of just putting your head down and just going, because there's nothing else that's going to make this work except you just doing, basically.
It's intense. It's very intense.
Yeah, but it was, looking back on it, we're better because of it. We have great investors because of it. The best investors came out of the woodwork because of it, right? Like, people who had conviction were the ones who were cutting checks in 22, to be frank.
Yeah.
And they've been fantastic supporters now along the way. And we wouldn't be here without them.
But I also think that there's a component of like thinking on your feet, right? To go, actually, why don't we raise venture debt? Well, actually, why don't we launch a new asset class on our platform at the same time and have a win-win?
You got to be creative. Yeah. And even
Yeah.
like in that time frame, the tides were changing constantly, right? So yes, we raised venture debt for ourselves. Very helpful. Bought us even further runway than we had. So that was great. But then when VCs weren't cutting checks, I flipped my strategy to say, I'm going after family offices. I need more cash in the door to get momentum, right? So we collected a lot of checks from family offices in that summer time frame of 22. And then I used that time to be able to rekindle conversation with VCs who had been talking to us for a while. And so that started working. And so that's when I switched to VCs. And then in Q4, I was seeing like there was no traction, there was no attention, there was no like energy in the fundraise. And so we activated certain groups to help us get this out there again, this deal, right? So they started in Q1 of 23. And then obviously SVB happened, and I didn't really need the help anymore because everyone started coming to me. But it's about feeling the changing shift in the tides and the winds to be able to capitalize on what is resonating at that point in time specifically, and knowing when to flip the switch to something else when you've exhausted that option and going to a different one, because now they're the ones that are interested. It's a lot of feel, honestly, and being attuned to what's going on around you.
No, exactly. I also think that the other component is, I think Peter Thiel posted this the other day. It's selling a discount to the future, right? That's the vision.
Yeah, exactly. And I'd like to think that the vision that we pitched for the Series B is really the one that I think has a future here, right? And I think we've barely scratched the surface on what we can become. We've spent a long time, now we're about 6.5 years into it, building a foundation for what I think hopefully will be the de facto infrastructure for the future. But you had to have a VC that buys into that, because I can promise you we did not have a lot to show for it. We didn't have a lot of revenue to show for it, didn't have a lot of tech to show for it, especially not in 2021 and 2020, that's for sure. But they saw it, right? They saw the market opportunity. They saw a team that could execute. They saw the beginnings, the little green shoots of what it could be. And they made a bet, and that's VC, right? It's making a bet on the future, paying up for it a little bit now, but in reality, it should turn out to be a significant discount to the future potential.
No, exactly. But you raise a good point that is around the team. So talk to me a bit about the change in the team and the team building as you go through each phase.
Yeah, I think how you manage a 5-person team is different than how you manage a 15-person team. It's different than how you manage a 25-person team, which is different than how you manage a 100-person team, right? There is different levels of structure you have to implement along the way, and different levels of, I think, ways to motivate, inspire along the way. And it changes constantly, right? So that's one element of it. I would say I think I'm the youngest person on the management team. Pretty sure that I am. And I like to try and keep it that way. I think I know what I don't know. And if you heard my background, I spent 2.5 years in finance, definitely not doing fixed income. So this is not my expertise by any stretch of the imagination, right? I ran a consulting company after that gave me a extremely modest product and tech background, I would say. So all that considered, I knew where my gaps were personally. And I knew that I'd have to fill those gaps with people with very strong domain expertise, DCM experience, market data experience, all of which would be able to help me, because I knew I wouldn't be the one to try and drive that. So understanding your shortcomings as a founder means that you can build a team that can surround you, that are significantly better than you at all those little things that you cannot do. And we've been able to do that here. I've been very fortunate to surround ourselves with a great team that I think has stayed with us through the ups and downs. Our average tenure at the firm, we're 6.5 years old, right? I think it's around like 3 years and 9 months, roughly, give or take. That's a long time for a fairly young company, right? And I think that speaks a lot to the culture that we've created. It speaks a lot to the traction that we've had, especially recently, that they believe in what we're building. And I think the next years in front of us will be the most exciting, even better than what we had this year, which is arguably a very good year.
Yeah, no, definitely. And so let's hit on the punchline, because talk about percent today in the platform, because you guys essentially are going to democratize private credit, right? It's an amazing asset class. Everyone wants to put their hands on it, right? direct lending space, I think it's a 1.6, 1.7 trillion and growing, and everyone's trying to deploy capital. But what you're doing is you're democratizing access, right? You're letting the little guys get a taste of that without needing to have a write a big check, right? So talk a bit about that to the audience.
Yeah, and I think democratize is an interesting word because you immediately get drawn to let's get retail involved, right? Which for sure, that's I think where we cut our teeth, how we got started. But you know enough about the private credit space to know actually the institutional guys, the small ones, also actually don't have access to a lot of stuff. Like they're seeing what they see, and that's about it, right? So our mission, our vision is to build infrastructure that can support this entire ecosystem from top to bottom to really democratize access, whether you're retail or institutional. Doesn't make a difference, because what is missing in this space is market standardization. It's data standardization. And so we've made it our point to create standardized deal structures that are rinse and repeat, to be able to create reporting on a weekly, monthly basis that allows you to price a bond if that's the case. And all of that should facilitate and get us towards a vision where we support everything from sourcing, structuring, syndication, surveillance, servicing, and secondaries. Those are our 6 S's that guide our product development. And that in itself means that everybody from retail, who normally has never gotten access to this because a KKR fund is way too large in terms of a minimum, to credit funds who are, $300 million funds, $100 million funds, those will be the ones to be able to get access to deal flow through primaries and secondaries that haven't existed before. It's a transformative time for private credit. There's not really anyone doing what we do, because what it is really hard. It takes a ton of time. It takes a bunch of VC money from VCs that believe in you when there's not a lot of traction. And all of that hopefully goes in a world where I think we can be the ones to really power the next evolution of private credit, which you haven't seen right now because it's viewed as very, very, I think, it's just very stuck in its own ways in the past and very analog.
Yeah, and you also give borrowers or small business owners to a certain size better access, right? Because you look at what happened in regional banks and just the banking system in general, right? It's hard to go and get a loan in the space.
Post GFC, it's hard to get a loan. Yeah, for
exactly.
sure. Yes, and I think non-bank lending emerged as part of that to solve that problem, right? To continue to be able to provide that type of liquidity into the market, which is great. But they're not a bank. They don't have a balance sheet to pull from a deposit standpoint. So they have to come to someone like us. But where we focus, and if we do our job right, it's really to be able to deliver on and support the debt capital markets life cycle of a borrower, like entirety all the way through, from the first $500,000 to the last 500 million. It can run in the same platform because the needs are very similar. It's just the audience on the lender side is different. And so we've built up a fantastic base of retail investors, family offices, RIAs, credit funds that can support transaction sizes large and small. And that's sort of the beauty of the platform and the marketplace and the exchange that we built here, that I think it really helps provide a level of transparency, efficiency, and velocity to the market that just really wasn't there before.
Yeah, no, totally. Look, I'm excited. I'm a member of the platform, so I love it. So I'm a huge fan.
Appreciate it. We'll take all the support we can get. But yes, adding one to our fan base.
Yeah, no, totally. So, thank you so much for being on today. It was an amazing conversation, very insightful. I'm getting texts from people on a lot of nuggets that you gave them. So appreciate it. Thank you, Nelson, for being on today.
Of course. Thanks for having me.
How we usually end the show is really the reverse. So it's really about you. What is your ask to the audience, and what are the types of people you want to connect with, and how can they help you?
Yeah, I think our audience and our client base is so broad and diverse that I would say if you're even remotely in and around the private credit space, I'd love to chat with you. If you're looking for yield, right, as a regular retail investor, it's free to sign up, percent.com, poke around. No, you don't need to provide any information. Don't have to get KYC just to look at our deals and see if it's interesting for you, right? We have direct investments. We have managed products that are more like similar to a basket of investments, all in one investment. If you are a family office or an RIA, we kind of make products for you, right? So that's going to be pretty unique. And then if you are a credit fund, we talk to them all the time, right? So that's all part of it. If you're looking for capital, if you're a SMB lender, a consumer lender, we work with you all the time. You are our target client base on the borrower issuer side. So it's all part of the puzzle. But yes, I'm very easy to reach, just Nelson at percent.com. and would love to hear from you.
Great, fantastic. Thank you, Nelson, for being on, and thank you to the audience for your continued support. Have a great weekend, everybody. Till next week.